Greetings everyone. So after completing the depreciable assets and the how to calculate the written down value method and uh, how to decide whether it will be a short term or a long term capital gain, we now move on to our next part, that is the rates of taxes on capital gains. Because after till now we have been discussing how to compute the taxable capital gain, but now we come to what are the rates those are implemented. So obviously we will do it categorically, first about the short term capital gain and then about related to long term. So when we talk about the short term capital gain, so under the Income Tax Act, I think the tax treatment of short term capital gain depends upon the nature of capital assets, which we have already understood thoroughly by now, I am sure. And it is the capital gain obviously arises when these short term capital asset, they are transferred and they result into profits. They are taxable under this head. However, the rate at which such gains are to be taxed, uh, that differs depending upon whether the asset is an ordinary capital asset or a specified security transaction covered under section 111A. So generally what do we find is that short term capital gains are taxed at a normal slab rates applicable to the SSE. This means that short-term capital gain is added to the gross total income of the taxpayer, and the tax is calculated according to the applicable income tax slab rate. Therefore, I would say that for assets, I would say that for assets such as land, building, jewelry, debt-oriented securities, or maybe other ordinary short-term capital asset, the gain does not enjoy any concessional tax treatment. The tax liability depends on the residential status, total income, and maybe slab rate applicable to the SSE. For example, if an individual is in the 30% tax slab earns short-term capital gain on sale of the land which is held for less than, suppose, prescribed holding period, maybe 36 months or 24 months, whatever is prescribed, such gain will generally be taxed at 30%, along with applicable surcharge and cess, whatever is there. However, the Income Tax Act will provides a special concessional tax rate under section 111A for certain specified securities transaction. And this concessional provision applies to short-term capital gains arising from the transfer of maybe equity shares in a company, unit of an equity oriented mutual fund, or unit of a business trust, provided that the transaction is chargeable to security transaction tax. So this point is very important to be kept in mind. What is security transaction tax, STT? STT is the tax which is levied on the transactions which are carried out through recognized stock exchange. The requirement of payment of STT ensures that the concessional tax rate is available only for genuine market transactions executed through recognized channels. Only then they take up these rates. Okay. And under section 111A, the tax rates applicable are, there is a variation in that. That is, please, it's there before you. That is 15% for transfers taking place before 23rd July 2024. Please note these dates. These dates are particularly very important because this will decide the rate of tax. So 15% if it is before 23rd July 2024, and 20% for the transfers which are taking place after 23rd July 2024. Thus, the Finance Act, that is number 2, 2024, has increased the concessional tax rate on such short-term capital gains from 15 to 20%. It has increased these concessional rate with effect from 23rd July 2024. Let us understand it better with the help of an example. For example, suppose an investor purchases listed equity shares and he sells them within 1 year. Maybe obviously it has to be through a recognized stock exchange. After paying of the security transaction taxes, suppose he has paid those STT. If the transfer takes place after 23rd July, then the resulting short-term capital gain, whatever capital gain was, it will be taxed at the rate 20% instead of the normal slab rate. And you know, this concessional rate is significant because it may be lower than the normal slab rate applicable to high income taxpayers. Therefore, section 111A or 111A provides beneficial tax treatment for short-term gains arising from genuine stock market investments. Otherwise, this benefit cannot be availed. At the same time, I would like to share that an important amendment has also been made regarding the units of business trust. Earlier, a concessional tax rate was not clearly available in certain restructuring situations. Now, the benefit of reduced tax rate under Section 111A shall also be available in respect of in respect of income that is arising from transfer of units of a business trust that were acquired by the SSE in exchange for shares of a special purpose vehicle, SPV, under Section 47, subsection 17. Okay, so this amendment was brought because it ensures tax neutrality and continuity of concessional treatment in cases involving business trust, such as real estate investment trust, that is REIT, and infrastructure investment trust, that is INVITs, etc. Hence, we can say that even where the units of a business trust are acquired through conversion or maybe through exchange mechanism is specified under the Act, the taxpayer can still enjoy concessional short-term capital gain tax rates upon transfer of such units. So, I think you need to understand that not all short-term capital gains are taxed uniformly, not at the same rate. Okay, ordinary short-term capital assets are taxed at normal slab rates, whereas specified securities, I hope this is clear, only specified securities covered under the section 111A, they enjoy concessional rate, but they are subject to the fulfillment of certain conditions. For example, conditions are payment of STT. So, therefore, identification of a nature of the asset and applicability of section 111A is very essential for the correct computation of tax liability on short-term capital gain. So, here I would say that certain amendments introduced by the Finance Act number 2, 2024 became very effective during the financial year 2024-25 itself. Therefore, applicability also depends upon the date of transfer. Okay, so I hope this is clear to you, and not only the date of transfer, and the nature of the assets also. Both the things have to be kept in mind while deciding that. So, this was about the short-term capital gain. Now coming to the next, that is long-term capital gain. Tax rates of regarding the long-term capital gain. So I hope you remember your long-term capital gain is on the long-term capital asset, gain on the long-term capital asset. That is an asset may be held for more than whatever the prescribed period is. But when we talk about the rates, the rate of tax applicable to LTCG, it differs depending upon the nature of the capital assets and whether the indexation benefit is available or not, and also the date of transfer. Because again, the Finance Act number 2, 2024, it introduced very significant amendments in this regard. Again, the date remains same with effect from 23rd July 2024. Therefore, while studying the long-term capital gain taxation for the assessment year 25-26, it is very important to distinguish between the transfer made before 23rd July or after 23rd July 2024. So let us now go with and go in the details of that. So first we'll talk about the general rate of tax on long-term capital gain. So generally, if we talk about that, the taxable, the LTCG were taxable in generally. They were taxable at the rate of 20% after allowing the benefit of indexation. Indexation adjusts the cost of acquisition for inflation, that is computing the CII, etc. Thereby, because you found out already with the help of the practical examples that indexation reduces the capital gain value, isn't it? It is a benefit to the taxpayer. So it reduces the taxable gain and it ensures the tax is levied only on real gain rather than the inflationary gain. And accordingly, the transfer taking place between 23rd July 2024 to the LTCG is taxable at 20% after indexation. However, the Finance number 2 Act 24, it has rationalized the LTCG tax structure, and for transfers taking place on or after 23rd July 2024, LTCG shall generally be taxable at 12.5%, but the indexation benefit will not be provided or will not be available in this case. So I repeat, that tax rate has been reduced from 20% to 12.5%, along with the condition that indexation benefit will not be available in such cases. And the date to be marked here is 23rd July 2024, or that as per the Finance Act bill. Thus, the law has shifted from higher tax with indexation to lower tax without indexation. The intention behind this amendment is to simplify the capital gain taxation and create a more uniform tax structure. For example, if a long-term capital asset is transferred before 23rd July 2024, then the taxes will generally be computed at 20%, obviously, along with indexation. But if the transfer takes place after 23rd July 2024, the tax will be levied at the rate of 12.5% without indexation benefit. So this was about the general part. Now let us come to discuss the detail regarding the long-term capital gain on listed securities. As we had a diversity in short term also related to securities, here also we have a special tax treatment applies to certain listed securities such as listed shares, listed debentures, government securities, and unit of mutual funds in specified cases. Before 23rd July, what was happening here? That is, before 23rd July, the taxpayer had an option to choose a more beneficial tax treatment. Accordingly, LTCG arising from the transfer of listed securities before 23rd July was taxable at a lower of 20% after indexation or 10% without indexation. This provision benefited the taxpayers because they could compare both methods and they can select any one, resulting in lower tax liability. Okay, so they were given a choice that on your securities, maybe you can either you index it and pay 20% of tax, or you can go without indexation and pay 10% of tax. So this I should say flexibility was enjoyed before 23rd July. For example, suppose if indexation substantially increase the cost, 20% with indexation may result in lower tax, and if inflation impact was low, then 10% without indexation might be more beneficial. Thus, the law allowed the SSE to choose more advantageous alternative. But however, these things changed after 23rd July 2024. The concessional regime was made more simple. Now what is happening? Now it is the LTCG on the listed securities shall be taxable at 12.5% without indexation. So no choice is given, I think. Therefore, the earlier duration, dual option system, that is 20 or 10% with or without indexation, it's no longer available for the transfer after 23rd July 2024. So that means in reference to securities, the indexation part has been done away with after 23rd July 2024, and therefore I told you in the very beginning that this date 23rd July 2024 is very, very important. Now coming to, let us talk a bit about indexation. Why indexation was earlier an important relief and relief available in LTCG taxation, because it adjusted the cost of acquisition for inflation, and this reduced the taxable gain especially in case of land, building and long held investment, especially suppose if you have inherited the property from your father or grandfather, that gave a lot of benefit. And under the amendment system applicable after 23rd July 2024, what is happening? The lower tax rate has been fixed, that is 12.5%, which has been replaced the earlier benefit of indexation in many cases. So therefore, while solving the practical problem for assessment year 26, a student might certainly check the date of transfer, the type of capital asset, and whether the old and amended previous provisions apply or not. Okay, so this can be checked out with that. So this was about the long term and the short term. I think there has been a major change in both the cases in terms of rates through the Finance Number 2 Act 2024. So this is an important turning point that has no doubt reduced the tax rate, but indexation benefit has also been done away with. So that is about the tax rates. Now there are some important notes that should be kept in mind, that is, in addition to the general rates that are applicable, long-term capital gains, the Income Tax Act 1961, it provides certain special provisions, that is, special provisions are for non-resident and foreign companies. and also transfer of listed equity shares and equity oriented units which are covered under section 112A. These provisions actually prescribe the concessional tax rates and special computation mechanism depending upon the nature of the asset and the residential status of the taxpayer. So, let us come down to the cases. Maybe first we will discuss the LTCG in case of non-resident and foreign companies. So, the Income Tax Act, it provides a concessional tax regime for long-term capital gains arising to non-residents and foreign companies from transfer of specified capital assets such as securities, etc. In such cases, the benefits of indexation is generally not available. And instead of allowing the inflation adjustment, the law provides lower flat tax rates for transfer taking place. The transfer taking place again the same date as we have mentioned as a turning point, that is before 23rd July. LTCG is taxable at 10% without an indexation, and on or after 23rd July 2024, LTCG is taxable at 12.5% without indexation. So, this provision mainly applies to gains arising from the transfer of securities, shares, and debentures, and similar financial instruments. Okay. So, as it is, I think it is in both the cases it was without indexation. And what is the rationale behind denying the indexation while providing concessional rate? Is to simplify the taxation and provide certainty for foreign investors. Since many foreign investors, they operate in global financial market where inflation adjustment mechanism differ across countries. Obviously, every country has different inflation rate, and therefore it differs. The Indian tax system actually provides a lower tax rate instead of indexation benefits. So, in both the cases, that is as far as we talk about the non-resident, it is indexation benefit is not available. So, maybe let me say that a foreign company, suppose it purchases listed securities and earns certain amount of LTCG. For example, let's say if it is rupees 20 lakh, okay. So, if the transfer occurs before 23rd July 2024, it will generally apply at 10%. If the transfer occurs on or after 23rd July 2024, the tax will be applied at 12.5%. Thus, the amendment which is introduced, through the Financial Act 2, number 2, 2024, it has increased the concessional rate applicable to the non-resident and foreign companies from 10 to 12.5%. So, you must understand here that the concessional rate is available, but indexation benefit is not available, and therefore such gains are computed on actual cost price basis. Okay. Coming to long-term capital gains under section 112A, it is a special provision. This section 112A is a special provision which is introduced for taxation of long-term capital gains arising from the transfer of listed equity share, units of equity oriented mutual fund, and units of business trust where security transaction tax has been paid. So, earlier such gains were fully exempted under section 10 subsection 38. However, to broaden the tax base, the section 112A was introduced to tax such gains exceeding a specified threshold. So, under this provision, LTCG up to a specified exemption limit remains tax free, and only gains exceeding the threshold are taxable at concessional rates. Okay. So, the tax rate under section, what are the tax rate under section 112A? If the LTCG, if it is before 23rd July 2024, for any transfer which takes place before this date, LTCG exceeding rupees 1 lakh is taxable at 10%. Thus, first 1 lakh of the LTCG is exempted and remaining gain is taxed at 10%. And for any transfer which takes place on after 23rd July 2024, LTCG exceeds 1.25 lakh, which is taxable at 12.5%. So, we can see that the exemption threshold has been improved or increased from 1 lakh to 1.25 lakh, but the tax has increased from 10 to 12.5%. So, this amendment also reflects a revised capital gain framework introduced by the Finance Act number 2, Finance Act number 2, 2024. I would like to give you some more clarification regarding the threshold limit. Actually, the clarification is that when the aggregate exemption limit of rupees 1,25,000 is applicable for long-term capital gains arising from the transfers made during the relevant previous year. Therefore, while computing taxable LTCG under section 112A, all eligible transfers during the years must be aggregated and exemption limit is applied only once. And for the assessment year 2025-26, a student should carefully note that the revised threshold of rupees 1.25 lakh applies for transfers made on or after 23rd July 2024, and the computation may involve the transitional adjustment because both old and new provisions operate during 24-25, financial year 24-25. Please remember this, okay? But at the same time, I think you must also keep in mind or must also remember this, that some important features of 112A is that it is applied to specified equity oriented assets only. STT payment is mandatory, no indexation benefit is allowed, concessional rate tax, etc., etc. So, we can say here that the long-term capital gain under section 112 and 112A provides very concessional treatment for a specific category of taxpayers and assets. Non-resident and foreign companies enjoy lower flat rate without indexation, while listed equity shares and equity-oriented investment covered under section 112A are taxed at concessional rates only after crossing the prescribed limits with effect from 23rd July 2024, making it very essential to determine the date of transfer and nature of assets carefully while computing the tax liability for the assessment year 25-26. So, I think that is all for today for this session. In this session, I hope this is very clear to you, the rates of tax under the short term and the long term gains, and what are the specified or special provisions attached, and how the date of 23rd July 2024 becomes so important while implementing these tax rates. So, thank you for today. Thank you.